Hello and welcome to our second session on financial statements module. Before I get into this session, I'd like to thank all the participants who have been responding to my mails and have participated in the discussion. I would like to request that please don't send the Excels to my mail ID. Please upload it onto the course kit. And I also invite you all to put your questions there, and I'll try my best to answer as soon as possible. I also welcome other members to answer to the questions. If required, they can send a mail to me if it is urgent too. In this session, our focus will continue to be on the financial accounting and financial statements through accounting equation, but we will make a shift today into the financial statements. The focus of this session is we will recap the previous session. We'll take up one more accounting equation, but while doing that accounting equation, I'll introduce the relevant concepts and also introduce the financial statements linked with the accounting equation. And after this session, we'll only see the business decisions and the financial statement without going through the accounting equation. Let us first recap In the last session, we saw a set of transactions and converted that into accounting equation. We saw that two important items on the accounting equation kept on changing. That is the profit and the cash. Every transaction affects the accounting equation in such a way that the sources at any point of time are equal to the assets. In this exercise, you might have come across these various items called outstanding interest, outstanding salary, outstanding rent, but the purpose or the intention behind those items will be understood today. So in this session, once again, I'm going to pick up a set of simple transactions, convert that into accounting equation. In the process, I'll explain the relevant accounting concepts. So the first one, the started business with capital is equal to cash on that particular date. So cash and cash is equal to 30,000, and the corresponding capital is also 30,000. So the accounting equation on this date is cash is equal to capital. You can ask a question that whose money is this? Capital is a money contributed by the owner, but the business is a separate entity. So one of the important concepts of accounting is that every business transaction will affect the accounting equation, that whenever there is a source, there has to be an asset. So if there is a source, there has to be a corresponding asset, or whenever there is an asset, there has to be corresponding source. Now cash in the second transaction, because of the second transaction, cash goes up by 20,000. No change in the capital, but another source called loan or debt, which is a liability, arises, which is 20,000. So the loan is a liability of the firm which they have to return. Capital is a money belonging to the shareholder, but this 50,000 belongs to the firm. So there is a difference between the firm, the business enterprise, and the business owner, and that is another important concept of accounting. The other concept is the business entity concept. The business entity concept says that the business and the business owners are two different entities. So therefore, the financial statements are not of the owners but of the business. When we say that balance sheet of Infosys, it is the balance sheet of Infosys, not Mr. Narayan Murthy. And that is the business entity concept. Now they purchase stock for cash, so 30,000. So the stock goes up by 30,000, whereas the cash reduces by 30,000. No change in the capital, no change in the loan. Purchase stock on credit, once again the stock increases by 50,000, but no change in the capital, but a new liability comes into picture, and that liability we give a name for the time being as a creditor or payables. Okay, creditors or payables, 50,000. You may ask a question here that when the transaction is on a credit transaction, why are we recording it? Why is it necessary to record a credit transaction? The purpose for which we are recording the credit transaction, or the concept behind this recording of the credit transaction, is given a name called the accounting, is called the accrual concept. The accrual concept says both cash and credit transactions should be recorded. By default, the accounting is called accrual accounting. Then you are selling goods 40% of the stock. You have 80,000 stock. You're selling 40% of the stock for cash. So cash goes up to 120,000. Cash goes up to 120,000, but the stock is reduced. Stock is reduced to 60% of it, reduced by 40%. Okay, so as a result, no change in the capital, no change in the creditor, no change in the loan, but a profit comes into picture, and the profit is 100,000 minus 40% of 80,000 minus 40% of 80,000. So there is a 68,000 profit. So profit is equal to the sales 100,000 minus the cost, corresponding cost. We are not deducting entire 80,000, but the cost of the goods sold. As a working note, let me write down here. Cost of the goods sold is 40%, and that 40% is into 30 plus 80, so 32,000. This is again backed by a concept called the matching principle, or the matching concept. The matching concept says that the revenue should be matched with a corresponding cost to determine the profit. I repeat, the revenue should be matched with a corresponding cost to determine the profit. So profit is equal to 100,000 minus 32,000. So therefore profit is 68,000. Salary per the month is 3,000. This was the question which one of you asked in the last on the basis of the last equation. The salary per month is 3,000. Salary paid is only 18,000, but this is accounting year is 1 year. So salary will reduce, cash will reduce to the extent of 18,000, but because of the accrual concept, the expense, the profit will reduce by 36,000. You may ask why 36,000 in a minute. The salary for the period, salary for the year is equal to 3,000 into 12. Salary for the year is 3,000 into 12. Whereas you paid only 18,000, so there is an outstanding salary which is a liability. The outstanding salary is 36,000 minus 18,000 is the outstanding salary. No change in the creditor, no change in the loan, no change in the capital, no change in the stock. So the total is 150, and the total is 150. Assets is equal to sources, and the sources here is the capital, loan, creditors, profit, and outstanding salary. Now you can see the rent per month. We can take the working note again. Rent for the period is 2,000 for the year is 2,000 into 12. But rent paid is 36,000. So therefore cash will reduce by 36,000, but the expense for the period, because of the matching principle and accrual principle, the expense for the period is 24,000. So in this case, payment is more than the expense, so there is an asset called advance rent. The advance rent is 36,000 minus 24,000. 36,000 minus 24,000. So let me recap that. So advance rent is an asset because the expense is 24,000, but the payment is 36,000. And so in the determining the profit, I'm going to reduce the expense. Determining the cash in hand, we reduce the entire 36,000. Let me consistently show the same, use the same cell. So therefore, the cash will reduce to the extent of 36,000. The profit will reduce to the extent of 24,000. The excess of the cash paid is considered to be an asset. If the payment is more than the expense, is an asset. If the payment is less than the expense, then it is a liability, which is the case with outstanding salary. And interest, even if it is not mentioned, because of the accrual concept, we have to show the interest. Before that, let us complete this equation. No change in the loan, no change in the creditor, no change in the outstanding salary, no change in the stock. So the total of sources side is 126,000 and the total of the asset side is 126,000. You can see that no other transactions given, but because of the accrual concept and the matching concept, it is necessary to show the interest for the period. And let us assume that interest has been paid. So interest for the period is 66,000 minus, 66,000 minus 2,000. 2,000 because it is 10% on 20,000 for year is 2,000. And as a result, your profit will come down by 2,000. No other change, no change in the capital, no change in the stock, no change in the advance rent, and no change in the creditor, outstanding salary. So the accounting equation is ready. Let us recap this and observe this accounting equation. It is clear that two important items on the accounting equation, cash and the profit, cash and profit keep on changing. So But why is cash changing and why is the profit changing is an important question one need to understand. In order to find the changes in these items, therefore, it is instead of converting the transactions into the accounting equation, but keeping in mind the relationships and the accounting concepts that I've introduced today, it is possible to prepare the financial statements. When we prepare the financial statement, we'll see that at any point of time, the equation reflects the balance sheet. So, what are these financial statements? The financial statements, as we have already seen in the last class, the financial statements are the balance sheet. Balance sheet will show the sources and assets on a particular date, on a particular date. Income statement will show the profit or loss for a period. The cash flow statement will show the change in the cash position or cash in hand during a particular period. Okay, during a particular period. So therefore, every business decision, as I've been mentioning right from the day one, will affect the equation, but in the process will affect the income statement or the cash flow statement. So it is possible to prepare the financial statements from the business decisions directly too. So let us take the same decisions and prepare the financial statements. In the process, I'm introducing to you these financial statements, and henceforth we will continue to be with this process of converting the business decisions into financial statement and then pick up one by one financial statement, get into the depth of these financial statements. But let us make some assumptions. Accounting period is 1 year. What does that mean? It means that I'm not going to close the balance sheet till the end of the year. I want to find the profit for the year. I want to find the change in a cash over a period of year. So let us start. As a policy, as a principle, and also to enable you to convert the decision, take one by one, read transaction by transaction. Don't get overwhelmed by the set of the transactions all at a time. So in the process, you are actually going to see the financial items very clearly: incomes, expenses, assets, liabilities, equities, receipts and payments. So started business with cash. So you have to ask a question: what is this? It is a source, and whenever there is a source, you have received that. So therefore, a receipt, you have received the money, and that receipt is because it is a capital. And what is that receipt? As we have mentioned here, the receipt is because of the capital. Let us take the second one. Once again you have received 20,000. So observe this, it's a receipt, so I'm writing under the receipts, okay, and it is a loan, and loan is a source, and loan is a source. So then you're complete. So a receipt can be as of now, can be capital, can be a liability, and slowly we'll improve our understanding of the word receipts. A receipt can be a capital or a liability. Why will you receive money? You receive money, the business will receive money as a capital, or a business will receive money as a liability. Later on we'll see other types of receipts as we move along. The next transaction is purchase stock for the goods, and that too for cash. Okay, for cash. So when you're purchasing the stock, you're acquiring an asset. So, and that asset name is a stock of goods. And because you purchase stock for cash, you have to make the payment, and the payment is 30,000 for. So payment is maybe for acquisition of. So let me also write down here. Your payments may be, okay, the payments are for acquisition of asset. Okay, asset purchase. The payment is for asset purchase. Next, purchase stock on credit. You once again purchase the stock, and the stock purchased is 50,000. You have increased the stock, but you did not make the payment, but created a liability called creditor. Created a liability called creditor. So, increase in asset from 30,000 to 80,000 may result in sometimes an outflow of cash or creation of a liability. Now comes, you see, there is a sale. First time we are selling the goods. Till now, you raised money, you borrowed money, you purchased stock, and you purchased stock on credit. First time you're coming across an item which is an income. We call that sales. And you're selling that for 100,000. So sales is a receipt, 100,000. So you can see that you have one more receipt called income. So receipt can be capital, receipt may be liabilities, or receipts may be some incomes. But because of the matching principle, whenever there is a sale, there has to be corresponding cost. Because of the matching concept, whenever there is a sale, there has to be cost of goods sold. And what is the cost of goods sold? The cost of goods sold is 40% of 30,000 plus 50,000. So that is the cost of goods sold. And the cost of goods sold is arising because of the matching principle, which was not visible in our accounting equation. Where is the cost of goods sold? The cost of goods sold was not directly visible here, but the cost of goods sold is now very clearly visible as an expense. So financial statements make it more explicit and are more transparent than the accounting equation. But that means an asset has become an expense. So the asset will come down to the extent of 32,000. Cost of goods sold 60. Yes, you can see that once again. Sales, let me recap. Sales is an inflow. The cost of goods sold, 40% of that becomes an expense, and the asset to the extent of 32,000 is reduced. So whenever there is a sale, there has to be a COGS, and the sales may be in the form of cash. If you don't receive cash, there will be an asset. But in this case, you have received the cash. Salary per month is 3,000, but salary paid is 18,000. First, let us write down salary as an expense. The salary as an expense is 3000 into 12, which was not visible here. In this case, we don't know how much is expense. But did you pay that money? The payment, the salary you paid is only 18,000. So the payment, the expense is 36,000. Payment is 18,000. So there is an outstanding salary. An outstanding salary is 36,000 minus 18,000. So 18,000 is a liability. And the liability, if the payment is less than the expense, there is a liability. Whereas you see here, in case of a rent, once again, rent, I have to show the rent because as an expense using the accrual and matching principle, it will be for the period, 24,000. But how much you paid for the rent? The rent paid is 36,000. So the payment is more than the expense. So there is an advance rent which is an asset. Let me recap that. An expense, if the payment is less than the expense, there is a liability. If the payment is more than the expense, is an asset. Now, as I mentioned, we have already recorded all transactions, but even if not given, you are bound to show interest because of the accrual principle, the way you're going to violate that. So interest is 0.10, assuming that's an annual interest. Now let us assume that interest is paid. Let us assume that you pay the interest. If you don't pay, there will be an outstanding interest. But in this case, there is no outstanding interest. So let me recap by taking all the expenses. That if the expense is equal to the payment, no asset, no liability. If the payment is more than the expense, there is an asset. If the payment is less than the expense, there is a liability. Now, since all the transactions have been entered and recorded, we can now it is necessary to find the profit. Necessary to find profit, because the very purpose of preparing the financial statement is to determine the profit. So profit is equal to income minus expenses. Okay, income minus expenses. So profit is equal to income minus expenses. Income is 100,000, so profit is equal to 6,000, and the profit is income minus expenses, which is 6,000. What will you do with the profit? For the time being, I'm ignoring the tax. Okay, this profit belongs to the shareholder. So if no information is given, let us assume that profit is retained. Okay, which we have taken in the previous example also, is a profit is retained in the business, and as mentioned, retained profit is a source of the business. The retained profit is the source, and so our income statement is done. As I mentioned, income statement shows the profit or loss for the period. In this case, ignoring the in tax, we have a profit of 6,000. Profit of 6,000. Now we'll find the cash in hand. Cash in hand is receipts minus payments. So cash in hand is equal to 150 minus 86,000. Cash in hand is 150 minus 86,000 is the cash in hand. cash in hand, and cash in hand is an asset, so cash in hand will be shown on the balance sheet as asset. So the cash flow statement is also done. The purpose of the cash flow statement is to record receipts and payment and determine the cash in hand. So we'll now total the asset side and total the sources side, and the asset side has to be equal to the sources side, which is the case because the accounting equation has to tally and will tally. The accounting equation says at any point of time the sources are equal to assets. But the advantage of preparing the financial statements over the accounting equation is that in accounting equation we don't know what are the expenses by just seeing the income statement, by seeing the accounting equation. But here we can know what are the expenses, why did cash change, how did you arrive at profit. Profit is 6,000, you can see it, and a profit also here 6,000. But we are not very, the accounting equation is not clearly showing how did you arrive at this 6,000, whereas in the financial statements you can easily see, very clearly see the profit determination. An important relationship between these financial statements that the profit comes from the income statement to the balance sheet, and the cash in hand is coming from the cash flow statement. So profit from the income statement and cash from the cash flow statement completes the relationship between balance sheet, or will show the interrelationship between the financial statements, that is the balance sheet, income statement, and a cash flow. To recap, as I said, it is possible to convert the equation, the financial decisions, into the accounting equation, which we have done in the first example. We also did the same thing by taking another set of transactions, converted into the accounting equation. But accounting equation has a limitation that it cannot exactly tell why is the profit changing, why is cash changing. Therefore, it is better to prepare the financial statements. The financial statements very clearly shows the incomes, expenses, cash receipts, and cash payments. It also very clearly shows the various sources and various assets on a particular date. So as we move along, we will try to consolidate this particular understanding that any business decision, or rather every business decision, will affect the balance sheet through the income statement or through the cash flow statement. In other words, every business decision will involve the financial items, and all these financial items will appear on the balance sheet, income statement, or cash flow statement. And this process of converting, or in the process of converting the business decisions into financial statements, we are actually using certain principles which are accepted universally as accounting concepts, and they are the dual aspect concept, business entity concept, the accrual concept, matching concept. The accrual concept says both cash and credit transactions will be recorded. The matching concept says the profit to be determined by matching the revenue with the corresponding cost. So thank you very much.